Hey guys, welcome back to the channel, best place for long-term stock investors. What we're going to talk about today, number one would be MyNews. It's now below IPO price, interesting times. And number two, a stock that's not performing too well as well would be Tenaga. So yeah, watch the video until the end to know our verdict. As usual guys, none of what we say should be taken as financial advice. If you need that sort of advice, please speak to a professional. Another disclaimer is that we do not own either of the two stocks mentioned in this video.
So is there still an opportunity in the palm oil industry? Well, we'll be discussing all this in our next deep dive on the 14th of July, where we will be covering a helicopter view of the industry, which stocks we think is good and bad, and whether the industry still have legs to run. We still have the early bird discount link though. You can find the link at the descriptions or comments.
Okay, Jonathan. So let's start with MyNews. Some context, guys. MyNews is now below, IPO, right? And this is on the backdrop of its hyper-growth expansion into higher grade, at least versus the typical MyNews store, higher grade kind of convenience stores, which is very Korean-based, CU-Mart.
Yeah.
So here are some of the numbers. I want to get your thoughts on what do you think about its its revenue, its profit, and things like that.
Okay, so I thought when during a recovery theme, right? So for example, in 2021, I was expecting everything is going back to kind of normal. It's recovering, but actually I didn't quite expect that their revenue is actually dropping lower than pandemic times in 2020. And not only that, their losses also were actually taking quite a hit. You can see that they make a 9 million loss in 2020, and now it dropped I think it's around 4 times in 2021. So that is actually pretty shocking for 2020. But I think it's understandable because in the next few slides, we're going to see why it actually dropped quite a bit.
And I think if we don't do as much reading, what you will be very cautious about, to your point, is that you think with COVID, MCO lifting, right? People start going. Yeah, but exactly. Yet, we are seeing in 2022, actually, right? This is not even 2021. 2022, there's some recovery, but 2021 was disappointing.
Yeah, so actually, I was expecting sales to be better, actually. Not profit. Profit, I understand. Yeah. But sales is why not performing?
But let's look. Yeah. Let's look. So here's the quarterlies.
Yeah, so if you look at the quarterlies, right, they have been making losses. I think if you look at their net profit, they have been making losses for 7 quarters straight. Yes. Because of the again, we're gonna be discussing later. Actually, I'm not gonna talk a lot on the quarterly. It's just a micro view of snapshot of how have they been performing quarterly. So you can see that there are some quarters they are performing okay, but then when you thought that they're gonna be performing better in the next quarter, then again it's another dump.
Yeah. Especially it's the quarterly stuff. So I think the sales portion of the company is one mystery, but I think an even bigger mystery, or at least uncertainty, would be the profits, and we'll be talking about it a little bit on. So yes, share with us why all of this is happening.
Okay, so this is actually their latest quarterly reports. I believe this is the second quarter, if I'm not mistaken. Yeah, so the reason why they are actually not really generating any great profit, or I'll say positive or even improving their losses, is basically because of this thing called the selling and distribution expenses, which actually includes this item called depreciation. So there's actually a lot of outlet and inventories actually got write-off and depreciated. Correct. So that actually increases the cost of them managing their company. But if you look at their sales-wise, at least there's some light. It kind of shows that people are already visiting inside the convenience store already. So that is a good head start. Right. But their expenses-wise, I think it's understandable because, again, I don't know why I keep repeating this, but we're going to be talking about this in the next slide.
Just to be clear, right, the depreciation expense, they're not recorded here, correct? Probably recorded somewhere in cost of sales, perhaps.
Actually, I'm not sure, but to my knowledge, I think it's under selling and distribution expenses.
Sure, but definitely we can see it in the cash flow statement.
Yes,
right?
yes.
Okay.
Okay,
Yes. So, why is all these expenses, is it justified? Like, does it make sense?
Okay, so it actually makes sense because if you actually follow MyNews quite well, they actually have this plan of expanding their outlet actually quite aggressively in 2021.
100 stores.
100 stores in 2021, and they actually allocated about 50 million to set up all of these stores. And if you want to know the little bit of the details, they are actually trying to like build more CU stores. If you don't know what is CU is basically, it's like a convenience store, like a Korean-like convenience store. It's something like your Family Mart. I don't know whether the management will actually like say anything, but it's something like that from how I understand.
Sure.
Yeah, and then there's actually 20 MyNews Super Value stores and all the existing stores. So one thing that the management actually pointed out is that you cannot expect once they like set up all of these stores, they can actually straight away make a profit or even break even. They actually give a specific period where if you look at the highlighted, right? I actually highlighted that it's going to take about 3 years to actually break even.
Yes.
But I think these 3 years, when he mentioned this, was in part of 2021. I'm not sure. So I'm not sure whether this gestation period will be longer than expected.
Right.
Yeah, because when I was reading a lot of analyst report, right, a lot of them were saying that the gestation period may be longer than expected.
Sure. And some context also is that I think our good friend Rondi, right, he wrote something on Stockbit, and he said that right now, based on he attended a physical event with them, and right now in the middle of 2022, it is claimed that the utilization rate is already 60%, something like that, around there lah. And he was comparing it to Family Mart. Right, Family Mart took something like exactly they said around 2 to 3 years before they become profitable. I have my thoughts on that, but yes, please continue. I just wanted to add that context for everybody.
Actually, nothing really much. But if you want to know more about this CU store that they're actually expanding, right? We actually did interview with the management.
Yes, you can check out. Maybe we'll put the video here.
Here. So if you want to look at the short form, which is I believe is around 15 minutes video. So we did a cut short video. We put the links in the description, and also you can maybe click on the right hand side of the video. But if you want a full length video, which is about an hour long, that video is going to be in our SIB 2.0 program, which you can find the link in the description.
That's right. Okay, moving on. So this is the cash flows. So we can see here that the depreciation is growing by almost 20% every year, right? And so this is actually adding. And if you include the depreciation of the rights of use, which is right here, if you add them together, right, it's 30 over million in depreciation. That's pretty big, right? Because if you go back and you see the profit loss, right, it's something like 11 million. You know? So if the depreciation starts to reduce, you can see very quickly profits will start to appear. But yes, what are your thoughts on this?
I actually highlighted these few things, which is their inventories written off and inventories wastage, and also their write-off. That has actually been increasing. And if you actually, I'm not sure whether you can get it from the AR or QR, but I think I've studied somewhere that their wastage actually has been reducing. They have actually been managing their inventory wastage very well during 2021 COVID also. So that is actually one thing that we can actually compliment the management. They have been actually trying to pull down costs pretty well. I mean, they stopped hiring a third-party logistics company because some goods, right, it's like perishable like within a certain amount of period. So right now, whatever they're doing is all in-house now. So their logistics and whatnot, they didn't really hire someone outside. So they can actually manage their wastage by themselves. And I think that is actually a pretty commendable move by the management.
So for those of you who are looking at the numbers, when it grows positive like that from 2.6 million positive to 6.9 million positive, it means that the wastage is reducing, correct?
I guess so.
Yes.
But I guess so. Yes, correct. Yeah.
Because otherwise it wouldn't be like if there's more wastage, they would have less money.
Yes.
In that sense, right? Okay.
And also one thing to note is that their operating cash flow is positive. I mean, has been growing quite.
It's very, very
tremendous.
positive, right? And if you look at it and if you compare it to what was the market cap again? Market
I
cap
believe
is
it was
375 million.
I think that was IPO. The current market cap, I think, is around 279.
Right, 279. Yeah, there you go. Yeah. So imagine if you have 50 million in operating cash flow. That is
40.
about five times, right? Roughly, 5 times operating cash flow. But of course, free cash flow is more important in that sense.
Yes.
But let's move on. Balance sheet. So here I'm guessing the reason why it has a net debt, right? This is net debt, is because they are again expanding.
Yes. Yeah. They're expanding a lot. And actually, this is actually quite a concern to me because with the rising interest rate right now also, it will definitely affect their P&L because of more finance costs they have to pay up.
Yep.
If you compare to like previously, they're actually in a net cash position and they're actually growing around like, I believe they are trading around 20 times PE. Yeah, and it makes sense because they are growing at a rate of it's like a linear uptrend. And now they are getting debt, and then they have to wait for their CU stores to be profitable. Have to wait for those gestation period. I think there will still be pain in MyNews for quite some time. I don't know how long. I don't know whether suddenly
we never know.
Yeah, we will never know. So
hopefully maybe we get a Korean pop star to come into our CU and boost again, like how Blackpink boosted Super Ring, right?
OFI.
Yeah, so maybe we conclude this segment here. What is maybe I'll give my verdict and you give yours. So I believe that the big challenge is twofold, right? The first is the revenue, the second the profit. So what do I mean? With the revenue, really you have to compare CU with Family Mart and 7-Eleven. And in some ways, all of them are very clear, right? Family Mart and CU are probably competing in one segment, but 7-Eleven is in a segment of its own. It probably competes with MyNews, the red one, right? I believe that the way 7-Eleven can expand, if they're actually expanding their 7 cafes right now. They have over 2,000, I believe, stores nationwide, 7-Eleven, and I think they're planning to build 500 7 cafes. And their strategy is a lot more scalable, and I use that word very a bit loosely because the nature of convenience store is this. Once you pass the Klang Valley region, especially, or maybe Penang, all these highly dense areas, what will end up happening is that every store you build will yield you less revenue. Because the footfall, which is the people that go in and out of the store, will reduce, right? Other states are not as densely populated. And secondly, other states will also have a lower, what we call basket size, which is the amount people will spend per person. So that's true for all three as they expand, Family Mart, CU Mart, /MyNews, and of course 7-Eleven. However, I would argue that the reduction for 7-Eleven as they expand out of Klang Valley will be lower than a CU. Why? Because 7-Eleven, where they focus on a lot of fried food, a lot of food that all Malaysians also like.
Right. Okay.
But with CU Mart, I think beyond certain areas in the Klang Valley, it's not for sure people in, let's say, Pahang or people in Johor will really, really like, as a whole, Korean food. It's a very niche kind of product. It's, of course, higher value, quote unquote, than the typical 7-Eleven. But I do worry that as they scale, the drop off in the revenue per store will actually be a lot higher. Because, and I would argue, I could be wrong, but I think each CU store probably costs more to build than a 7-Eleven or even a 7 Cafe. But that's my theory. I think that I want MyNews to succeed. I want CU to succeed, and I think they probably will. But another thing to consider then is also their FPC unit here, right? We talked about the FPC here.
Yes.
If the FPC can support like 1,000 or 1,005 stores, then that would be a challenge actually, because then to hit consistent utilization and to make more sense in terms of how much, like the way I would explain it is, because the expansion is going to be less profitable, so you want your FPCs to be, I would say, smaller. So you're more efficient.
Yep.
But if it's too big, then that might be a problem. Whereas someone like 7-Eleven can afford to have a bigger FPC, let's call it, because they are likely to get more footfall and perhaps even more revenue. But what do you think? That's just my crazy opinion.
I think I think I cannot really give much comment because I didn't really study the convenience store space that I can actually offer an comment or opinion. But looking at right now, right, is it priced in? Personally, I think yes. Is there more pain? I also think that maybe there will be more pain. Yeah, I think we shall move on to Tenaga.
We shall.
Yes, we'll be having a free live masterclass training. If you are looking to build a 6 to 7 figure stock portfolio and you don't know how, look no further. You can check out our free training in the links in the comment section and description.
Okay, so we talk about Tenaga right now, Jonathan. This is the
favorite among all retail investors.
To be specific, I think dividend investors. We didn't manage to snapshot the dividend, but they tend to be.
You know, the funny thing is that I heard a lot of people saying that Tenaga is a blue chip stock.
Yeah, blue chip. Yeah, you're dropping your chips right now. You know? So you can see, right, past 5 years is like down 43%. Past 2 years? Am I seeing that right?
Yes.
2.5 years.
This one is during the COVID crash, and then it dropped even more.
Yeah, so 32%. Again, I think the big lesson, before we even go in our analysis, is that there's no such thing as risk-free.
Yeah. Actually, another fun fact is that this price point is actually similar to the 2013's price point.
Yeah, so
back to 2013, man.
It's like GE 13, I think, something like that, right? Okay, so why is this happening?
Okay, so this will actually affect a lot on the company, TMB itself, but not on the consumer, I believe.
Yeah.
Because the government, thankfully, he decided to still continue on with the subsidy and also not increase tariff. And when you don't increase tariff, when coal prices are actually increasing, which is part of...
Which we will look later on.
Which is actually part of Tenaga's cost of raw material, right? That will actually pressure their profitability of the company. So that one simple analogy itself already causes a lot of panic into the company. Because it just doesn't make sense, right? When raw material price, and then in order to counter this, actually there's this thing called the ICPT, Imbalance Cost Pass-Through. But we're going to cover that later. What is it? But in simple form, it's basically when your coal price is increasing, by right, the most common sense or even things that actually make sense for Tenaga to do is actually for the government to actually increase the tariff, not leave off.
And for some context also, the reason governments want to put tariffs is because politics, right? I remember in 2020 COVID, there was a big case about Tenaga rates skyrocketing. Do you still remember?
I think so. Yeah.
It got massive, right? And there was a huge outcry. It wasn't even. I mean, it was a big bill on average. I was, I think, in the thousands, or at least in the high hundreds. And so as a result, people were really angry. So you need the tariffs there to control. But of course, now as we can see, the cost structure, right, of for those who all don't know, even though electricity is a cleaner form of energy, but to produce electricity actually requires a lot of, ironically, fossil fuels, which in this case is coal.
Yeah, actually the reason why you are seeing these two graphs, right, I mean, if you just look at the graphs on the side, on the left-hand side, which is the average electricity tariff, you notice that in 2015 to actually 2021, tariffs are actually increasing slightly. And if you match it with the coal price, the right-hand side, which is on the 2015 to 2021 also, it is also somewhat increasing. I mean, we are kind of reacting to the increase in coal price.
Right.
But right now, you're seeing a massive, huge jump in coal price. But if you look at our tariff, it's
so I'm not sure, and perhaps that's something we should have done, is to look at how much is coal as a percentage of Tenaga's cost. Do we have it?
I think so, if I'm not mistaken.
Here, right?
Yes, so it's here. So if you look at how much percentage that Tenaga actually uses coal, it's about 56.2%.
Right.
And so imagine coal price increasing.
And gas is increasing as well.
Yeah,
right?
gas is also increasing, and that's the sad part.
But how much, the question is, how much is all these commodities contributing to Tenaga's total cost?
I believe that I actually didn't really dig.
Yeah, fine. That, no issue. But the point I want to add is that, so you can see, right, coal went from 500 to 388, and of course gas also, I think it has gone up quite a bit as well. However, the tariffs, right, has gone up from 23 to 39. So that is roughly I want to say 80% increase, 70% increase, roughly there.
33 to 39.
23.
Oh, 23 to the, yeah, so
right?
roughly.
Somewhere there, right? So that's only 80% increase, but here is 50 to almost 400, which is roughly 8x.
Yeah.
Not 80%, right?
Yeah.
So 8x, for those who don't know, is like 700%, right? So that is a problem. Even though the cost, total cost percentage might be lower for commodities in Tenaga, it's still going to be a huge problem.
Yes.
And that's a politics barrier, right? This tariff here, a lot of it has to do with politics. But yes, let's yes. So
so I actually got this from their annual report. So if you look at the left hand side, their FY 2021, the average coal price that during that time was around 116. Basically, it's a double up in coal price.
Right.
It's another thing to just say that their electricity generation costs will increase by 33%. I mean, this is their estimation.
Yes.
So so for those who are actually holding Tenaga, this is something that you actually need to be aware of.
Yes.
Yeah. So if you look at the other side, okay, so this is their cash flow. I mean, although it looks pretty neat, because their operating cash flow is like higher than net profit in a way. But if you notice, right, the cash flow is actually dropping.
Yes.
Operating cash flow, if you look at 2019 to 2021, is like dropping downwards. Not only that, their profits also has been dropping, which what shareholders want to see. They want to see a company that actually grows their profit. And actually, I wanted to point out this is that back in the 2013's price point, right, which is Tenaga share price. I mean, I don't know what's the market cap, but I think I know the share price is around 8 ringgit. Back then, in 2013, they're actually making, I would say, more than double, a little bit more than double, almost double than what they're actually currently making. So, and not only that, Tenaga has been expanding diversifying their business, right?
Yeah,
in a way
into
like
renewables,
right, renewable
like
and whatnot, right? So actually, if you look just based on this, right, Tenaga, is it 9 years ago? 9 years ago was actually more profitable than Tenaga now.
Yeah. I think a lot of it is like the so-called commodity cycle back in the day was actually reducing a lot, right? Commodities had a bad run over the past decade. It's only up till recently where things start to pick up a lot more, right?
Yep.
So here's the balance sheet. You can see.
Another net debt also. Basically, back then, it's basically just a comparison between back then 2013 versus now.
Yep.
Yeah, that's like they 4x their
Correct.
debts.
So you can see, right? They have let's use let's say 2015.
Yeah.
So for every, let's call it dollar of that, they produce. Okay, I'm gonna butcher the math, so guys, apologies, but you get the logic, right? For every dollar of that they have, they produce maybe 5 cents of cash flow.
Yeah,
but today, for every dollar of that they have is like something. Okay, my math not very good anymore lah. But basically, it's very low lah, right?
Yes.
So they are borrowing a lot more to produce a lot less.
Yeah.
And that, as a, if you were to own a company, that's something that's very worrying lah.
Yeah. But the great thing about this is that it's becoming more and more cheaper, which is a price point that we actually never really see. In over the past 5 years. So could it be undervalued?
Yeah.
I don't know. Could it drop more? Maybe. You never know.
I will leave my verdict after we talk about this slide, which is that, yes, can you explain this slide?
I mean, it's very simple. It's just that when the government actually announced, or actually I think they know about this news for us. Because I cannot recall when was the tariff news actually came about. But assuming was at the same day or before, 1 or 2 days before, you notice that actually all of the foreign investors are actually pulling out their position away from Tenaga. Yeah, and the only one who is actually buying heavily is the retailers. So if you look at this, right, local retailer, there's like a 441 million buying.
Is this, catching a falling knife?
Yeah.
Yeah, but just to conclude, I'll give my conclusion and you can give yours. For me, this is a good lesson in investing in monopolies.
Yes.
So not, people like to invest in monopolies because only they can make the money. But you have to know what type of monopoly. This is what we call an artificial monopoly, where it's through a stroke of a pen that they get the revenues. But guess what? Through a stroke of a pen, they get the revenues. With a stroke of their pen, they can also limit their revenues.
Yeah.
So whilst it's true that Tenaga is more or less the only player in town, with the exception of maybe YTL Power and Malakoff and all that, if the government wants to control your revenue, it doesn't matter whether you're a monopoly, right? You're in some ways a sad monopoly, lah.
Yeah.
But on the flip side, from 1992, I don't know if you know, from 1992 to 2011, even though electricity consumption grew and all of this grew, right, tariffs grew, whatever, the stock price of Tenaga actually didn't move. Can you imagine? From 1992 to 2011, it was totally flat. So could we be seeing something similar since the share price now is flat?
Yeah.
Compared to, or it's the same level as 2013, or maybe you have to wait another 10 years. I don't know. But certainly, in investing, there's no, nothing's too black and white. But yeah, what's your verdict?
Actually, to me, it's just that there's a misconception between what stock is a blue chip stock. I mean, to me, a blue chip stock is when they can constantly generate cash flow and it's growing, profitability is growing, and there's like no restriction. I mean, there's a particular mode, and that mode is not being restricted by third parties, for example, like the government or whoever, or maybe even the consumers, for example. So take, for example, like Apple.
Yeah.
Apple phone. So you notice that Apple phone's price has been increasing, right? And we're still willing to buy.
Oh, absolutely.
Yeah, and we are not even complaining. Yeah, so that is to me somewhat a blue chip characteristic. Yeah. So yeah, I think that's about it.
So guys, if you enjoyed the video, as usual, like, comment, subscribe, click on the notification bell so whenever new videos pop, you know it fresh. And of course, share it with someone who finds this sort of video entertaining. Always give us your feedback, advice, even criticisms in the comments. We always love to hear them as long as they're relevant. Yes. And I will see you in the next video.